Okay, so in the previous chapter, chapter 9, we've learned several capital budgeting decision rules. We've learned the advantages and disadvantages of each decision rule, and we learned why the MPV decision rule is better than other decision rules. So given the cash flows, we have 0, which is the initial cost of the project, and C1, C2, etc., which is the future cash flows from the project. So given these cash flows, we now know how to make capital investment decisions. But the question is, how do we determine these cash flows from the project? And this is what we're going to focus on in this chapter. So we're going to learn how to determine the relevant cash flows for proposed investment project so that we can decide whether or not we should undertake the proposed investment project. So let's look at the project cash flows. The cash flows that should be included in a capital budgeting analysis are those that will only occur or not occur if the project is accepted. And we call these cash flows incremental cash flows. So if you think about a firm, the firm has its assets, which generates cash flows. Typically, the firm consists of many investment projects. So by focusing on incremental cash flows, we can isolate each project from the firm and analyze separately, which makes the analysis much easier. So we can think of each project as a mini firm. The project can have its own assets, and its own cash flows. So we can analyze, in this way, we can analyze each project in isolation from the firm. So the question is, how do we determine the relevant cash flows? To determine what cash flows are relevant for the capital budgeting analysis, we should always ask ourselves, will this cash flow occur only if we accept the project? Here I emphasize the word only. If the answer is yes, then it should be included in the analysis because it's incremental. If the answer is no, it should not be included in the analysis because it will occur anyway. If the answer is part of it, then we should include the part that will occur because of the project. Let's look at some of the common types of cash flows and see if we can determine which cash flows are incremental cash flows that are relevant for the capital budgeting analysis. So we have sunk costs. Sunk costs are costs that have accrued in the past. And these are not relevant incremental cash flows for capital budgeting analysis. It's very easy to dwell on sunk costs. It's just natural human psychology. We also regret things that have happened in the past. But as I say, we should not cry over spilled milk. The sunk costs are not relevant incremental cash flows for the capital budgeting analysis. How about opportunity cost? Opportunity costs are cost of lost options. These are relevant incremental cash flows. It's also very easy to forget the opportunity cost. For instance, if you're currently working full-time and you're thinking about going back to school. So the cost of going back to school not only include things like tuition and boarding, but also include opportunity costs, such as your future income from your current job that you have to give up to go back to college. The opportunity cost can be quite substantial. Next, there are side effects. The side effects can be positive or could be negative. A new project can benefit some of the other projects, or it could hurt some of your other projects. Side effects, either way, are all relevant incremental cash flows for capital budgeting analysis. How about net working capital? Where net working capital is actually relevant incremental cash flows are very easy to forget. When we're making investment decisions, we have to invest in not only in fixed assets, but also we have to invest in current assets as well. How about financing costs? Well, financing costs are relevant and real, but for capital budgeting analysis, financing costs are not relevant incremental cash flows. We analyze the cost of capital separately from the project cash flows. So firm has assets on the left side and debt and equity on the right side. The capital budgeting analysis involves the asset side of, or left side of the balance sheet. On the other hand, cost of capital analysis involves the right side of the balance sheet. Because we're going to do the cost of capital analysis separately from capital budgeting analysis, we should remove financing costs from the income statement when we determine project cash flows. Very important step in making capital investment decisions is to construct pro forma financial statements. Pro forma means projected. So the pro forma financial statements are based on our projections or our estimates. Here's some of the refresher on how we compute financial cash flows. So OCF, operating cash flow, is equal to EBIT, earnings before interest and taxes, plus depreciation minus taxes. And cash flow from assets is OCF minus net capital spending minus change in net working capital. Okay, so let's look at some of the examples. So let's look at this shock attractant project. Suppose we think that we can sell 50,000 cans of shock attractant per year at a price of $4 per can. So the revenues or sales is going to be $200,000. So this is because there are 50,000 units at $4 per unit. So the revenues or sales is going to be $200,000 per year. And it costs us about $2.50 per can to make the attractant. So these are the costs. And there are two types of costs. There are fixed costs. There are variable costs. Variable costs. The fixed costs do not depend on the number of units that we sell, whereas variable costs depends on the per unit cost. So the variable cost here is $125,000 per year. So this is equal to 50,000 units at $2.50 per unit. And a new produce like this typically has a 3-year life. So we can generate these revenues and incur these costs for the next 3 years and require a 20% return on new products. And there are more information. The fixed cost for the project, which includes things like rent on the production facility, will run about $17,430 per year. So $17,430 per year. So that's the fixed cost. The total cost, fixed and variable, will be about $142,430. So these are the cost for the project. Further, we'll need to invest a total of $90,000 in manufacturing equipment. For simplicity, we will assume that this $90,000 will be 100% depreciated over the next 3-year life of the project. So we're going to invest in, we're going to buy fixed assets, which costs $90,000. We're going to depreciate this asset to 0 over 3 years on a straight line basis. So depreciation is going to be So 90,000 divided by 3. So 90,000 minus 0 divided by 3. So that is equal to $30,000. So that's for depreciation per year. This is per year, $30,000 per year for 3 years. So the $90,000 of fixed asset will be completely depreciated. Furthermore, the cost of removing the equipment will roughly equal its actual value in 3 years. And so it will be essentially worthless on a market value basis as well. Finally, the project will require initial investment of $20,000 in net working capital. So net working capital requirement is $20,000, and the tax rate is 21%. So this is the information that we're given. And based on this information, we're going to construct the pro forma, the financial statements. First, let's look at the income statement. The sales, which is here. Sales is $200,000. So sales 200,000. So this is the income statement, pro forma income statement, and costs is here. Is 142,430. Then depreciation is $30,000. And if you subtract the expenses from the revenues, you get earnings before interest and taxes. So you get $27,570. So that's your EBIT, or operating income. And when we are doing capital budgeting analysis, we removed the financing expenses. So because financing costs are not relevant incremental cash flows for capital budgeting analysis, so interest is 0, and earnings before taxes is equal to EBIT. So we remove this from the analysis. So taxable income is, which is earnings before taxes, is equal to the earnings before interest and taxes, because interest expense will be removed from the analysis. So taxes, assuming the tax rate of 21%, you'll have to pay $5,790. So we subtract that, then we get net income, which is $21,780. So this is here pro forma income statement. Next, And so we're going to look at the projected capital requirements. So the net working capital requirement is $20,000 for the project. So net working capital is we have to put up this $20,000 at the beginning of the project to maintain $20,000 throughout the project. So the change in net working capital would be 20,000 the very beginning of the project and 0 afterwards. How about fixed assets? So net fixed assets. So purchase the equipment which is worth $90,000, and we depreciate $30,000 each year. So net fixed assets or fixed asset net of depreciation would be 60,000 in 1 year, 30,000 in 2 years, and 0 in 3 years. So depreciation is 30,000, 30,000 30,000 each year. So this is capital requirements for the project. Now we are ready to compute project the cash flows. So we can compute the cash flows. So first we have to compute operating cash flow. So operating cash flow, OCF, is you can start from EBIT and then add back depreciation minus taxes. So EBIT is 27,570 plus depreciation is 30,000 minus taxes is 57,90. So that is equal to 51,780. So that is our operating cash flow. So OCF is $51,780 per year for 3 years. And then we subtract change in net working capital. So we have to subtract that for year 0. And then there's nothing going on afterwards. So it's 0, 0. But at the end of the project, we can recover this net working capital. So $20,000 that has been tied up to the project can be freed up when it's over. When the project is over, we can get it back. And we're going to assume that we can get 100% of it back. So there will be a cash inflow of $20,000. And we subtract net capital spending, and we purchased the fixed asset worth of $90,000. So that's our fixed asset investment. And then we have no further investments in fixed assets. And at the end of the project, we can can sell the fixed asset, get some of the initial investment back at the end of the project's life. But we're going to assume that the fixed asset will be worthless at the end of the project. So we get nothing back at the end of the project. Now we can compute cash flows. So cash flow from asset for year 0 is minus $110,000. And afterwards, there's only OCF, 51,780, 51,780, and then for year 3, the cash flow from asset is $71,780. So these are the cash flows for the proposed investment project. And if the required rate of return is 20%, should we accept the project or should we reject the project? Well, we can answer this question by computing the NPV. So net present value at the required rate of return of 20% is negative 110,000 plus 51,780 over 1 plus 0.20 plus 51,780 over 1 plus 0.20 squared plus 71,780 over 1 plus 0.20 cubed. If you compute this, we're going to get $10,648. So we should accept the project. Okay, so now that we've gone through the entire capital budgeting process, from estimating incremental cash flows for proposed investment project and deciding whether or not we should accept the project, and we're going to see some of the details of the capital budgeting analysis. So there are alternative definitions of project OCF. So our definition of OCF starts from EBIT. Earnings before interest and taxes, and add back depreciation and subtract taxes. But there are other ways to compute OCF. First alternative is the bottom-up approach. The bottom-up approach, as the name implies, starts from the bottom line, which is the net income. And then you add back depreciation. Let's see if this definition actually works. So here, the OCF is net income plus depreciation. So 21,780 plus 30,000. So this is equal to $51,780, which is the same as here, which is we calculated before. So this alternative definition actually works. But there's a caveat. This definition is correct only if there's no interest expense subtracted in the calculation of net income. So in our capital budget analysis, we remove the financing cost. So that's why this bottom approach definition of OCF works. So we have to be careful. This definition doesn't work in other situations. There's the second alternative definition is it's a top-down approach. So as the name implies, we start from the top line, which is sales. So you start from the top line, which is sales, and then you subtract costs and taxes. And there's a third definition, which is tax shared approach. So from the top-down approach, the taxes is equal to EBIT times the tax rate in our capital budget analysis when interest expense is removed. So the EBIT is equal to sales minus costs minus depreciation, which is EBIT times the tax rate. So we substitute this in here, then we get our third definition, which is sales minus cost. So S minus C minus T is S minus C minus D times T. So this is equal to, you can collect these two terms. So sales minus costs. So 1 minus tax rate, 1 minus T. And then the remaining term is minus times minus D times T. So plus depreciation times the tax rate. This is called depreciation tax shared. So the higher the depreciation, the lower the taxes, and the higher the operating cash flow. So again, depreciation is a non-cash expense, and the only cash flow effect of deducting depreciation is to reduce our taxes. So as you can see here, there are three alternative definitions of OCF. We can use whatever is the most convenient given the situation. And a tax-shared approach is often very convenient in capital budgeting analysis. So let's talk about depreciation a little bit more in detail. Depreciation itself is a non-cash expense, so it is only relevant because it affects taxes. But taxes tend to make things more complicated. In the previous example, we used straight line depreciation, and the depreciation expense is calculated as the difference between the initial cost of the asset minus the salvage value of the asset, which we assumed to be 0 in the previous example, or divided by the number of years. But this straight line depreciation is used only for simplicity because very few assets are depreciated straight line for tax purposes. As you can see in the depreciation tax shared definition of the OCF, the higher the depreciation, the lower the taxes, and the greater the operating cash flow. So firms like to depreciate fixed assets as much as possible and as early as possible. Even though the firm will be paying exactly the same dollar amount of taxes over the project life, delaying paying taxes is beneficial because of the time value of money. So if possible, firms would like to depreciate 100% of the assets in the first year to maximize the tax gains. And sometimes the government allows firms to do that to reduce the firm's tax burdens. This bonus depreciation is sort of a tax break for firms in difficult times. The depreciation expense used for capital budgeting should be the depreciation schedule required by the IRS for tax purposes. And this is known as the maker's schedule, modified accelerated cost recovery system. As the name implies, the maker's schedule allows firms to depreciate more in early years and less in later years, which helps firms reduce tax burdens. To determine the depreciation expense, we first need to know which asset classes the fixed assets belong to. Equipment used in research, for instance, belongs to the 3-year asset class, whereas most industrial equipment belongs to the 7-year asset class. Then we have to use the appropriate depreciation expense as shown in the table. We can simply multiply the percentage number shown here by the initial cost to determine the depreciation expense each year. In the previous example, we assumed that the salvage value of the fixed asset is 0. And this is also for simplicity. In practice, the salvage value is rarely 0. For instance, we can sell the equipment after we are done with it for a project, and we may be able to recover at least a small fraction of its initial cost. The salvage value is based on the market value of the asset, and if the salvage value is different from the book value of the asset, then there will be tax consequences. If the salvage value is greater than the book value of the asset, then firms have to pay taxes on the difference, because essentially firms made money for selling the used fixed assets. So this is this part here in this equation. On the other hand, if the salvage value is lower than the book value of the asset, then firms receive tax credits on the difference, which will lower the tax expense. So let's look at the example to see how all this actually works. So you purchase the equipment for $100,000 and it costs $10,000 to have it delivered and installed. So the initial cost of the asset is $110,000. And based on the information, on the past information, you believe that you can sell the equipment for $17,000 when you're done with it in 3 years. The company's marginal tax rate is 40%. What is the depreciation expense each year and after tax salvage value in year 3 for each of the following situations? So let's consider the straight line depreciation first. So straight line depreciation, the depreciation expense will be, so using straight line depreciation expense will be the initial cost minus salvage value divided by number of years. So the initial cost is $110,000 minus salvage value. The salvage value is before tax salvage value. The salvage value is $17,000 divided by 3 years, which is a project life. Then you're gonna get $31,000. So the depreciation expense will be $31,000 each year. And then the after-tax salvage value will be salvage value minus the tax rate times the salvage value minus the book value. So using this straight line depreciation, we depreciated to, the asset will be depreciated to $17,000. So the book value of the asset will be $17,000. The salvage value and the book value, in this case, will be equal. So there is no tax consequences. So after-tax salvage value will be the same as before tax salvage value of $17,000. How about if we use 3-year maker's schedule? Let's refer to this maker's schedule here. So we'll be using the schedule in this table. So the depreciation in the first year will be $110,000 thousand times 0.3333. So there will be 36,663. So there will be the first year depreciation. And then after the first year, the book value of the asset will decrease by the exact this exact amount of the depreciation. So value will be $110,000 minus 36,663. So there will be $73,337. So there will be the book value of the asset. In the second year, the depreciation will be 110,000 times 0.4445, so 44.45%. So this will be $48,895. And after the second year depreciation, the book value of the asset will become, so now this minus this, $24,442. Third year depreciation will be 110,000 times 0.1481, 14.81%, shares $16,291. So, and after the third year depreciation, the book value will be this minus this, so $8,151. So in year 4, the depreciation will be 110,000 times 0.0741, so 7.41%. This will be 51. So the book value will become 0. So under the 3-year maker's schedule, the book value of the asset will become 0 after 3 years. So the asset becomes worthless, at least on the book. So for during the project life, the depreciation expense each year will be with this. And how about the after-tax salvage value? So after-tax salvage value will be salvage minus tax rate times salvage value minus book value. So you can sell the asset at $17,000 after 3 years, and tax rate is 40% times salvage value again, 17,000. But the book value after 3 years would be, according to this maker's schedule, it would be 81.51. So on the book, we actually made money. So we have to pay more taxes. So the salvage value, after tax salvage value becomes, instead of $17,000, it's going to be $13,460.40. Okay. So this is all I want to talk about in this lecture. Thank you for watching. I will see you next class.